Hello, and welcome to Chicago Cultural Alliance's Meeting the Moment series. My name is Michael Scott, CCA Director of Programs, and I am joined today by CCA's Operations Manager and Session Co-host, Pooja Das. Our session today, Financial Storytelling, will be presented by Yvonne P. Afable and Jill Villanueva from Afable Consulting, LLC. Before we begin our session, we would like to answer the questions, why Meeting the Moment? Why now? Meeting the Moment is a professional development series designed to support cultural and heritage nonprofits during a time of rapid change and uncertainty. Through hands-on workshops led by experienced sector leaders, the program provides practical guidance across key nonprofit functions, including marketing and communications, fundraising, finance, operations, and collections. Participants gain actionable tools, shared learning, and access to one-on-one consultations with session leaders, ensuring support is both strategic and tailored. Meeting the Moment equips organizations with the clarity, confidence, and capacity needed to adapt, strengthen their operations, and continue serving the communities with impact. During the presentation, please be sure to use the Q&A function located at the bottom of your screen to share any questions that you may have throughout the session. We will reserve time at the end of the presentation to answer as many submitted questions as possible. You are also invited to use the raise hand function, also at the bottom of the screen, at the end of the presentation if you would like to come off mute and ask your question as well. Also, please remain on the webinar until the very end to help us continue to improve this series by answering just a few survey questions. This session is being recorded and will be archived on the Chicago Cultural Alliance website under Meeting the Moments, where you will also find many other valuable resources. We hope that you find this session and the sessions that will follow a supportive resource for you and your team for many years to come. Please welcome Yvonne and Jill to the digital stage.
Hello, everyone. Let me share my screen. Welcome to Meeting the Moment, Financial Storytelling. I am Jill Villanueva, and this is Yvonne Afable.
Good morning.
This is our agenda for today. Our session goals are to review and understand key financial reports, understand some key metrics and dashboards, be able to tell your financial story, and we're also going to compare and interpret some financial stories for different organizations. So right now, we're going to have our first poll question. It's going to pop up in a little bit. And the question, please take a couple seconds to answer. The question is, how often do you review financial reports? Your options are monthly, quarterly, annually, or no comment. All right. And then the answers should pop up momentarily. Great. So majority of you, half of you say monthly. Let me close that. So best practice is monthly review of financial reports for your organization. So this is a table of the statement of financial position. This is indicating which accounts that you use on your financial reports, depending if you are doing your reports on a cash versus accrual basis.
So if you remember from the first financial webinar, we define cash basis accounting as similar to a retail store. So you're only counting revenue and expenses when cash exchanges hands. So when we receive funds for goods that are purchased or for services that are received, that is revenue. And then for expenses, when you pay your vendors in cash or checks, however you pay them, that would be considered an expense. In the second column under accrual, it gets a little bit more complicated. So when revenue is earned, whether cash is received, it counts as revenue. And when expenses are incurred rather than paid, so it doesn't matter if cash has changed hands, it would be already considered an expense. So you're matching the revenue and expenses to the period. Plus, for nonprofit organizations, there is a more complicated rule for revenue. So when you receive an unconditional promise to give, you record that as a revenue and also as a receivable, which you see here. So this statement of financial position, also called a balance sheet for corporate, for-profit organizations. This is only the asset section, so it's the first part of the report. What we're trying to show is how you get more accounts when you're doing accrual accounting. So when you're doing cash, of course, you're going to have cash accounts, bank accounts, savings, CDs, investments. And you'll also have fixed assets, which are basically equipment, your building, the land, maybe branding as an intangible asset. However, when you're doing accrual accounting, there's going to be more accounts that show up on your report. You'll still have the cash and the fixed assets, but you'll also have receivables. So those unconditional promises to give, pledges from your board where they sign something and they say, I'm going to give 10,000 for the next 5 years. You can record that as revenue as long as there are no conditions. You can also record prepaid expenses. This applies a lot to, let's just say, health insurance, Blue Cross Blue Shield. You must pay the expense before the period that is covered. So payment in March for April. In March on your report, this is going to be considered a prepaid expense. Also, if you're renting your office space, you will put down a security deposit a month, 2 months, and that will be considered an asset because it's not an expense. It is meant to sit on your books on your financial position until you leave the space. And on the last row, this is the right of use when you have an operating lease. So there are several rules that apply to accounting in general, and one has to do with operating leases that makes it look much more complicated. But when you're renting a space, what you'll see is that you're going to display an asset for the right to use the space, but you're also going to show a liability. The reason being on accrual accounting, if you're leasing for a certain amount of time, whether it's 3 years, 5 years, your rent expense will remain the same for that period because it's the same space. So the balancing portion of that, even though you're having, let's say, 3 to 5% increases in your rent every year, according to your lease, the offset to make sure that the expense remains the same is affecting your balance sheet or your financial position. So just remember, this is a photograph on one day.
And then this one is the liabilities. And as we said in the first session, liabilities is what the organization owes.
So
And
here
then
we
this
have the
shows.
same. Oh, sorry, Jill.
Go ahead.
So on this page, we have the same columns, basically showing you that cash basis accounting um, only has a few accounts. And we're doing like some hard and fast rules because you might think we're doing something in the middle. We have some payables, we don't have this account. Um, but you can be also on a modified cash basis somewhere in between, but we're talking about like just cash and just accrual. So in this particular case, you're probably wondering why would credit cards be on liabilities? Um, if you're using an accounting system, let's say like QuickBooks Online, you can connect your bank accounts so that they feed transactions into a space where you code them or you match them to existing transactions. Credit cards would be automatically created as a liability account in that particular case. So it's under both cash and accrual. Payroll liabilities, in the same sense, the assumption is that you're using your system, whether it's QuickBooks or some other accounting system, to run your payroll. So they're also your payroll service, and they would automatically create what you owe for taxes for past payroll periods. And then the other two items that are in both columns are basically a line of credit or a loan that you take out, whether it's short term or long term. And you can see on the accrual side, you've got more accounts, accounts payable, basically bills that have been for expenses incurred in the period. Um, but haven't been paid out. And then accrued expenses, a good example of this, if it's the end of your fiscal year and you're looking at your vacation, your PTO, your paid leave, whatever that is, you're going to quantify that, the balances that are at the end of the year, and you're going to accrue that as an expense on your balance sheet. And so that is accrual accounting. Deferred revenue would be, let's say that a person can purchase like a membership for several years with your organization. So you can only record as revenue the years that have already passed, but for future years, you would consider that deferred revenue when you've already received the cash. Okay, and here you're seeing at the end the right of use liability, which is also part of the rule for operating leases. You have both an asset and a liability on your books in order to balance out the even expenses for rent throughout the lease period.
This part is the bottom of the statement of financial position or balance sheet. This is your net assets.
So for net assets, if you remember the equation, your assets, which is what you own or you have a right to, minus your liabilities or what you owe equals your net assets. In the corporate world, they call this your equity in for profit, right? This is your net worth. You can see that all four of these accounts will be appearing on your report, whether you're on a cash or accrual basis. We can talk about with donor restrictions. So, as nonprofits, we're receiving unconditional promises to give, but those promises can have donor restrictions built in. And there are two types. There's the time restriction, so they put a grant period into the agreement, the contract, the email, or they put a purpose restriction, and they can actually have both. So you want to make sure you're tracking that in your books. So that is net assets with donor restrictions. And then without donor restrictions, that's for general operating, there are no dates involved. For board designated funds or reserves, whatever the board is designating, the board will need to vote at a meeting to set aside net assets without donor restrictions. Okay, you can't touch this stuff with, but they can set aside a portion of net assets without donor restrictions for a particular purpose. And that has to be proof, like the supporting documentation is the minutes from the board meeting. And then the last section, the net surplus or deficit, we always like to pull that out for the year. That is the net of your revenue minus your expenses for the fiscal year, including both with and without restriction activity. And we'll see that on the report, so it'll be clearer. So I just want to summarize. Your statement of financial position is a photograph, a financial photograph of your organization on one day. It is also a cumulative representation from the very beginning of the start of the organization. So, from the first moment you organized or you incorporated, what you can do is basically take all of your past years' net surpluses and net deficits, and that will equal your net assets section on your financial position.
So right now is our second polling question. It should pop up shortly. Please take a couple seconds to answer.
And while folks are doing that, I would like to remind everyone that please, if you have any questions for Jill and Yvonne, please drop that in the Q&A at the bottom of your screen. And then also at the end of the presentation, you'll be able to raise your hand and come off mute if you'd like and ask the question directly. Thank you.
Thank you, Michael. The question is, do you formally reconcile your bank accounts monthly before issuing financial reports? And then the answers will populate shortly. So the majority of you say yes. And that is the best practice to do. You definitely want to reconcile your bank accounts monthly before issuing financial reports. And in terms of bank accounts, this applies to, of course, your checking, your savings, investment accounts, petty cash, credit cards, loans, and lines of credit.
Okay, we're jumping into the financial reporting, but I just want to make a comment about reconciling those accounts. It sounds like there's a lot, and there are, but it is best practice and it should be done timely. So when you think about closing your months, because you're reviewing reports every month, you should only review financials where all of the accounts have been reconciled. And the reason being that you want to ensure and you want to be confident that the reports you're reviewing as a management team, also providing to the finance committee and or board, right, are complete. And the only way you can do that is by confirming that all the transactions are recorded. And when we say timely, I would say do it in the first week when the bank statements are available after the month is closed. Okay. All right, so the order that we're going to show you the financial statements, these are going to be the four reports that we as a firm often present to our clients at board meetings or at management meetings. The first one is the statement of financial position where we just sliced everything into sections. Here you're not seeing the full report. We broke it up as well to have you focus on certain areas. And at the same time, we are going to bring up some sections that you should be focusing on as a reader of the financials as well. Okay, as you can see here, the organization's name is Artist Fund, of course. Their fiscal year end is December 31, 25. They have a calendar year fiscal year. This financial photograph, there's actually two. There's one as of the current fiscal year end and also as of the prior year, 12/31/24. So two photographs side by side. This is our preferred presentation. We also provide a dollar change column as well as a percentage change column. So you can see historically kind of the story that it's telling. On your asset sections, it shows from liquidity, like the highest liquidity accounts to the lowest. So starting out with cash, what I'd like to do is read it as if I'm presenting it. So your total assets are at 461,000. This is a 28% increase from prior year at about $100,000 more than prior year. And you can see in the change column, the dollar change, where those increases and decreases are happening. So largely your cash has increased by about 50,000 as well as your receivables. So you have more promises and maybe more earned revenue to collect on. While there's not much activity anywhere else on the rest of the assets section. And you can see that the bulk of the 461,000 is actually made up of your cash accounts as well as receivables. So those are the two largest sections of your assets. So you should pay attention to that. The other thing to mention, this account that's called undeposited funds, account 1400, is actually cash. This is cash or checks that you have in the office, right? Locked up in a safe that have not made its way to the bank. So it is in transit to the bank and should be added as part of the cash balance. So if you look to the right of this report, we have your total bank accounts of 292,000 plus your undeposited funds of 1,000 basically equals total cash of 293. If you take that total cash and you divide it by your average monthly expenditures for the year, which happens to be 40,000 for this organization, your cash runway is 7 months. This is a good metric to have, right? To tell your board your cash runway. I would say at minimum, you should aim for 3 months. 6 months is even better, ideal. And I've seen organizations who have a full year of runway or even 2 years, right? They've been around, super sustainable, doing a lot of fundraising, have increased their earned revenue, so their cash runway is longer. And so I would say that that's a note that you should always mention during presentations. Okay, the second part of the statement of financial position, like the bottom half, would be your liabilities and net assets. So normally this is put together on one page, but if it's expanded like this, you might have them on two separate pages. Your liabilities are $5,000, and that's decreased from the previous years. So we're not going to focus on that. The area we're going to focus on is in your net assets. As you can see here, where it says total equity, that's actually your total net asset line. That is 456,000 of the 461 total. So it is the bulk of the total, which is great. That's really where you want the large number to be sitting here. Because remember, assets minus liabilities equals net assets. So that 456,000 is 31% higher than it was in prior year. That's great news. You should highlight that in the presentation. And I want you to look at the accounts. So we have net assets without donor restrictions of 140,000. You're actually going to add the net revenue line of 107,000 to that to get the grand total for net assets without donor restrictions, which is 247K, right on the right there. And then what you have as with donor restrictions is 210. So the majority of your total net assets is actually without donor restrictions. If we make the assumption, I have the note on the right, if net assets with donor restrictions are all sitting in cash, so you've received all of those net assets and there's nothing in receivables, there's nothing outstanding to collect, then your unrestricted cash will be 84,000. So basically the way we came up with that is we took the total cash from the first page that has the assets, we deducted the 209,000 of with donor restrictions, and then we have your unrestricted cash. So I think that's always good to highlight because now you know that 209,000 of the cash that you have is actually restricted at this point in time. So this is just a summary that Jill's going to go over in terms of the financial position.
Yes, so this is what Yvonne just discussed about the statement of financial position. Remember that it is a photograph of one day of your organization. The numbers are all cumulative since the start of the nonprofit. And then if you add your net surpluses and or deficits since the beginning of the nonprofit, this will equal your net asset. And then a good metric to note when presenting financials or reviewing is your cash runway, your net assets with donor restrictions and without. And then your current ratio, which is your current assets divided by your current liabilities.
All right. So I'm just going to pause for a minute and answer Jen's question in the Q&A. What if the organization is making less than 20K? Would a financial report be suggested as well? I would say yes. No matter your budget, financial reports are basically how you know how well you're managing your organization. And so whether you're small or you're large, financials on a regular basis, reviewing them really helps you focus on the things that need focus on. So unless you have those financial stories, like maybe programmatically, you know what's going on, it's good to also equate them with the numbers. Okay, now we're looking at budget versus actuals for the same organization. This is actually the board's favorite report. And why is that? It's because they approve the budget for the fiscal year. And so they always want to see like, how are we doing against our approved budget? So we've sliced it up again. You're seeing revenue first. And it's very short, actually. So this is a collapsed version. So under each of these sections, like contributed revenue, there would be sub-accounts such as foundation, government, corporate, individual, board, and non-board. And under earned revenue, there could be tuition revenue, there could be ticket sales for events. Special event in this particular case would be a fundraising event like your annual gala or benefits. And then there's an account called net assets released from restriction. So we all know that what makes nonprofit accounting complicated is the fact that donors can restrict their gifts to the organization, to the 501(c)(3). And you are charged with tracking them, okay? Because that's the only way you'll know that you're actually using the funds to meet the restrictions from the donors. And this is how we do it. We create an account. This is the unrestricted section for net assets released from restrictions. And these are basically the amounts that have been promised to Artist Fund in years prior to 2025, but is actually meant to be used to be released in 2025, either because it's general operating and they gave you the period of fiscal year 25, or it's purpose restricted. And this is the year that that purpose was met, like the program was run in 2025, and therefore you can release the funds to go against the expenses for the year. And miscellaneous income is just the small interest income that we make on our bank accounts, is what's sitting in there. All right, so as you're comparing actual against budget, you can see that they did an amazing job in 25. They are 22% over the budget that was approved by the board. They are actually over budget on contributed revenue, earned revenue, and also on net assets released, while they have a small setback in terms of their fundraising for the special event, but that not meeting that budget is actually offset by the large contributed revenue increase that they have for the year. So this is a very good story that this is telling on the revenue side. Okay, now you're going to see a longer portion of the budget versus actuals, your expenditures, you have your actuals, you have your budget for the year, and then your dollar changes and your percentage variance. Now, the way this reads and the way your report should read is you're pulling up your largest expenses on the top, kind of the same way you're pulling up your largest revenue on the top. Because we read top to bottom, we don't want to see payroll like in alphabetical order and maybe sitting on the bottom. You want to organize your reports so your largest expenses are brought up. And that is almost always your team, right? Your staff. So whether they're W-2s, which is this top line, or they're 1099s like subcontractors and the professional fees line, those are usually organized on your expense side at the top of your report, at the top of this section. As you can see here, they also did a great job on their expenditures. They are almost at budget. So they're just under by $1,600. I'm going to say that's incredible budgeting skills right there by the team. And so in terms of the net operating revenue, which I've got on the side, there's like a lot of arrows, $40,000 surplus versus a deficit budget that was approved by the board. So the swing of 95,000 is a positive swing because they brought in more revenue than what they were expecting for the year, plus they managed their expenses to be under budget. Great news all around. If you wanted to look at the lines, of course, it makes sense that payroll has, is above budget. Maybe there were increases that were made that weren't planned earlier in the year. And in terms of another large variance, equipment and furniture, so they didn't make those purchases like planned in the year, as well as travel. So those are the three largest variances, and I always look to see what are the largest dollar variances when I'm reading reports. Now, this is where we computed the average monthly expenditures for that cash runway. So we just took the 483,000, divided that by 12, approximately 40,000 a month. Your other revenue and other expenditures section, this is your restricted activity. So your unrestricted activity stops at net operating revenue, and that is your unrestricted net. As a management team, as a board, as a finance committee, this line is going to be your focus. It's not going to be the net revenue line. It's going to be this line. How well did we manage our fiscal year, our operating budget? Okay, so I want to highlight that. Now, under other revenue and other expenses, your restricted activities also tracked separately. Your grants restricted for future fiscal years, you already have commitments that were made in 2025, but are really for fiscal year 26 and on. So, more time restricted, more purpose restricted grants that are not meant for 25, but meant for the future are below the line, below the net operating revenue line, so that you don't get excited that you have a huge surplus because this is not meant for 25, right? And then your other expenditures is basically the offset to your net asset release, which we saw on the page prior. We released 107,000, and this is exactly the same amount. So you can't count that money twice because it's already been counted when it was promised in prior fiscal years. What you can do is you can release it in this fiscal year to go against the expenses for the year, whether they're general operating or purpose restricted, time restricted. So you can get to the proper net operating revenue line. That is the purpose. So we take it out here so you're not double dipping and double counting that revenue. And that net other revenue line, so your restricted activity is actually providing an additional surplus of 67,000. So your overall net all in is $107,000. So this is a fabulous story all around for Artist Fund. They're doing a great job.
So this just summarizes what Yvonne just discussed about the budget versus actual report. This is a period of time up to a fiscal year for the organization, and it compares the actual revenue and expenses to the board approved operating budget. And we mentioned the different sources of revenue, like contributed versus earned, and which sub-accounts go under each of those categories, and then how to categorize your expenses to the highest amount on your presentation of your reports. And then also your surplus your surplus or deficit, both unrestricted above the line and restricted below the line as your overall net.
Okay, so we're going to
I,
go through
I
this and
just
now.
Yvonne,
Oh,
I'm so sorry. I just wanted to drop in for 1 second and just remind everyone that you are welcome to drop your questions into the Q&A box at the bottom. And also at the end of the presentation, you can raise your hand and come off mute. Sorry for the interruption. Thank you.
thanks, Michael. All right, our third report, statement of activity. You'll notice that this is for a period of time, just like the budget versus actuals, usually a month up to the full fiscal year, right? We're looking at the revenue section, and the only difference right now is that this is a year-to-year comparison. So you're taking fiscal year 25 actuals, the same from the budget versus actuals, and you're comparing it to the prior fiscal year 24. What we've also done is we've taken the information and shown you how to do a pie chart to maybe highlight it for those who don't like to read financials. Like, right, if we have artists on the board, they're like, give me some pictures to tell the same story. Contributed revenue plus your special event revenue plus your net assets, the NA, released from restriction is your total contributed revenue. Okay, so you can see on the pie that that is 78% of your total revenue for this organization, the earned revenue being 22%, and the other revenue, the miscellaneous income being absolutely so tiny, it doesn't even show up on this chart. So let's just say that you have a strategic plan, 3, 5 years that you have built, and it is saying that you want to increase your earned revenue to a level where it is 30% of your total revenue. So you have to look at your reports to see how you're doing on those goals and objectives that you have set up for the organization in terms of the strategic plan. And those goals and objectives that are also programmatic, but they have a financial kind of imprint, you want to make sure that you're tracking them. So I think this is a great way to show the board the composition of your revenue. Okay. The same way we did revenue, we did a pie chart for expenditures, but I just like to highlight the story that it's telling. Total expenditures of 483 actually went down from prior year, from 572,000. So if you go to the payroll line, you'll see like payroll increased slightly. But subcontractors, we have a huge savings on that line, and also on professional fees, right? And so the net operating revenue went up from 10,000, to 40,000. It quadrupled from the previous fiscal year. And I just want to point out on the restricted activity section in 2024, they had a deficit in that section because what they released was actually larger than any new commitments that were restricted. Again, you cannot control this section. You can't control what donors restrict their gifts for. So that created a deficit overall in terms of the net revenue line. Now, looking at the graphs, we are highlighting your top three expenses. As you can see, 46% is payroll. We combine the 1099 line, subcontractors, and professional fees, that is 35%. And then the light blue, 19%, we pulled it out and we can show that occupancy makes up 13% of that 19 total. And then the other 6% are all the other expenses that are listed that are much smaller. So I think that's another great way to do a dashboard of pie charts, bring out your cash runway, talk about your net assets as like more of a pictorial photograph, without all of the numbers. Just an easy way to relay the same information.
So this is just a summary of what Yvonne just discussed for the statement of activity comparison report. Your current fiscal year revenue and expenses are compared to the prior fiscal year activity. And it's the same actuals from your budget versus actual report, and it is a year-to-year variance.
Okay. Just like the budget versus actuals is the board's favorite report, this report confuses them and everyone else. It's no one's favorite. But I think it's important to look at, especially when you are on an accrual accounting basis. This is your standard statement of cash flows. Do not get this confused with like a cash flow projection that you're doing monthly. So this is for the full year. You're taking your net revenue, that's unrestricted and restricted surplus together of 107,000. And all of this activity is basically stripping all of those accrual entries that we made, getting rid of the receivables, prepaids, payables, all of that. And then you're coming down to a cash net. So if you were on a cash basis, your surplus would be showing as right under 50,000. So you increased your cash from the beginning of the year from 244 to 293,000. This amount of cash will equal your statement of financial position. And if you notice that 107,000 of net revenue is on every single of the four financial reports, that's how you can tell as a reader that everything is balanced. If they are not the same, you should question it. Maybe the period that they're presenting isn't the same from one report to another, but it's a really good way to check. So yeah, that's the statement of cash flows.
It's just a summary again of the statement of cash flow. It takes your overall net surplus or deficit on an accrual basis, removes all the accrual activities, and then gives you your cash basis net surplus or deficit. So this section of the session, we are going to discuss 4 different financial stories for 4 different organizations. The first organization is called NPO number 1. Oh, sorry.
As you can tell, Jill loves how I named these financials. You can tell which one she named and which ones I named. NPO number 1. So we're just going to take a quick look. I want you to review this report on your end and see what stands out. And then I'm going to point out what stands out for me. I always look at totals first. So like this is very collapsed. Total assets went down from last year. I can see that that's happening in other current assets, accounts receivable, while cash increased. So that's great. I'm not concerned about that section. Current liabilities, ooh, our liabilities in total are really large, but it's mostly long term. So we have 1 million of liabilities, and I'm looking at 25. But a lot of it is long term. So I'm thinking maybe some loans, a line of credit, probably more loans. And then current liabilities are accounts payable, even though it went down from the year before. So we should celebrate that, right? Is really high at 245 in comparison. Other current liabilities are also high. So the liabilities are just popping out as being too much. So as you can see, your net asset section, have you ever seen a negative net asset section? I mean, this really does happen with organizations, and you are able to come out of it, right? I have seen that happen with a lot of hard work. So the total net assets is negative because if you take the assets minus the liabilities, it is a negative number. So right now it's 239,000 negative in order for this balance sheet or financial position to balance.
So the
So,
main story it was telling that first organization, that the total liabilities are larger than the total assets. So then that's why it has a negative net assets.
and I just want to add that the way that you can come out of that, if your bills are really high, and I've seen this happen, you can call your vendors and offer to pay them, let's say, 50% of the balance that's outstanding and see if they would take that cash now versus trying to collect the full balance. And you can write off half of the balance. Like that is one way to do it.
This is the second organization called NPO number 2.
So you can be creative as to what this organization does. This is the financial position. This is a June 30, 25 year end compared to the prior year. And here I'm going to look at total assets. It looks good, 1.6. It's gone down by 18%. And I can see that that change is happening largely in cash, like 530,000. Receivables are up. Other current assets are up and fixed assets are down probably because of depreciation. So liabilities, they're lower, 7% from last year, so that looks fine. And then it looks like total net assets is positive. It's 1.4 of the 1.6 and largely with donor restrictions. So of the 1.4, actually a larger amount is restricted by donors. So the story this is telling me, so even though our net assets are large and it's the biggest part of the bottom section and liabilities are lower here, we've got, about 900,000 of bank accounts. Your net assets without donor restrictions, when you take the 170,000 and you add or you subtract the net revenue because it's a deficit, is actually a negative net asset without donor restriction. So what happened here? Because they received so many promises to give from donors that restricted the purpose or the time for those funds, what I see at this point in time is they're basically taking out like an internal line of credit where they're borrowing funds from the with donor restriction buckets to fund general operating expenses right at this moment in time. That is the photograph. Because remember, that is one day. And if most of this 1.6 million is actually just time restriction and their new fiscal year starts on July 1, it is a whole different story on July 1 and probably a much better story in terms of without donor restrictions.
So that's the main story that organization number 2 is stating. I'm just going to go to the third one for time. This
Yes.
is NPO number 3.
Yes. Number 3, their financial position. I'm going to say total assets 225. Looks like it's mostly receivables, little cash, low liabilities, but they have a surplus and they have a positive net asset balance with and without donor restriction. So this one's kind of easy. Low cash balance, surplus for the year. Mhm. and you can see that surplus here. We included the statement of activity as well.
Okay, the last organization is Let It Snow. I named that one.
All right, so this one, the budget versus actuals, it's showing basically on the net operating income line where we want you to focus is a positive number, a surplus. However, the restricted section on the bottom, which also includes in kind for the same amount, is creating a very large deficit. So overall, it's a deficit. But again, the focus is on the net operating or unrestricted surplus of 40,000.
All right. And remember, we can't control how donors restrict their contribution. All right. Thank you so much. That concludes our session on financial storytelling. And we will start the Q&A.
Yeah, thank you both so much. I'm happy to start reading some of those messages in the Q&A. And just as a reminder to everyone on the call, please drop your questions in the Q&A, or if you're interested in coming off of mute, you can hit that raise hand feature and come off mute and ask your question. The first question here is, do all CPAs or firms specializing in this type of work generally provide this type of in-depth report?
I want to say yes. I'm gonna make sure that I say yes on this. So we work with a lot of CPA firms as we're preparing for audits for our clients, and these are the four reports that they provide. So if you take a look at your audit, I think the only difference would be like they don't do a budget versus actuals, but they do a statement of activity, whether it's comparison or just for the fiscal year. So yes.
Great, thank you. Is it good to include in-kind donations?
Oh, okay. I don't see that in there, but thank you. Are we skipping some of the questions, Michael? I was just going in order the way you set it
I
up.
did move down the list just a
Okay.
bit. I thought that might be a good question to hit at the moment.
Okay. Is it good to include in kind? I'm going to say yes. In your auditors will also encourage that you keep a list of in kind donations that are non-cash, as well as support for that. And you're always asking the donors to provide the value. You are not putting a value on those amounts, it's the donor. It shows that there are people who believe in the organization that are willing to give of their time, attorneys or professional services, as well as donate goods for your events.
Thank you. The next question, how do you number separate grants?
Okay, so in your accounting system, there is a donor database built in. So we can talk about QuickBooks as a very affordable option for nonprofits. You can get it for almost free through TechSoup. So you would create customer profiles in there, and you can also use the functionality called projects to track every single grant that needs tracking. You're not going to want to do all of them because you're going to set up a structure where you don't have to track every single grant. But that's how you would separate it in a system.
Thank you. The next question, what does it mean to close a month and how long should that take?
I'm going to let Jill take that one because we have our best practice for closing months.
Um, how long should it take? It depends really, how many accounts you have. But actually, if you have a best practice of taking a look at your transactions, if you are able to on a weekly basis, your month close would be very short because you're pretty up to date with your transactions in your system, like QuickBooks Online. And then when you go and reconcile, it's connected to the bank feed. So it's a simpler task to reconcile your accounts. And then the majority of the time would be reviewing your financial reports.
Yeah. So I would say probably on the short end, like for a small organization with not a lot of transactions, it could be done within 3 to 5 days. For our clients, we do it by the 15th of every month. And we try to make it work in terms of the schedule for any meetings that we have to prepare reports for. Mhm.
Great, thank you. The next question is, when should reports go out to the finance committee and or board?
So we usually send out financial reports for the finance committee and our board a week before the meeting. So they have time to review and send any questions they have.
Great, thank you. I believe this next question is how can we get the PowerPoint material? We will be adding that into the resources that you can find on the Chicago Cultural Alliance websites. And there's a big banner at the top. It says Meeting the Moment. And once you click on that, you'll see soon a recording of this session and then all of the resources available, as well as all the previous sessions that we've had so far. I think this is number 7 for us at this point. In the next question, why do I need to review financial reports at all?
Oh, there's so many great answers to this question. For one, I'm thinking there's a lot of the management team that's on this webinar. You have the responsibility to run the organization programmatically, financially, and your board is charged with fiscal sustainability, right? How do you manage that without looking at your financials and seeing how much cash you have, what you have commitments to like vendors, what is your runway? How long can I exist without doing any fundraising at all? You know, if I am short staffed, can I afford to hire and expand my programming? Do I have to contract? Like all of these outward forces, losing NEA grants or some type of funding, how do you plan for those and right pivot without reviewing your financial story? In addition, as a 501c3, your financials are available to the public depending on like basically your total contributed revenue for the year. So if you're super small and you file a postcard, obviously nobody can see that. But for others, you can see like on Candid, the 990s that are filed for an organization on the Charity Bureau, the Illinois Charity Bureau Fund website, you can see audits that have happened for organizations. You need to review them so you know your own financial story because if your reports are telling the wrong one, and I have consulted with organizations that are like, that's not our story, then I say there's something wrong with how the transactions are being recorded. And actually, most importantly, because reconciling your bank accounts is part of like what you do timely, we have found fraud on organizations' books where checks have been copied or amounts have been erased and a larger amount is on there or a new payee is on there. You won't discover those if you're not doing the best practice process of reconciling your accounts as soon as the month closes. That is the only way we were able to catch it and make sure other fraudulent transactions were prevented. And I would like to say that they target nonprofit organizations for the most part because we have fewer resources. So you might not be paying attention to that because you're so focused on program. Also, as the board is approving budgets, how do you give them reports? Like, how do you tell them what's happening without just a program narrative? Where are we at with goals? Because they want to see hard numbers, right? So, for all of those reasons and so much more, you should review financial reports monthly.
Those are a lot of great reasons to do it. Next question, are there any advantages or disadvantages between using a calendar year or a fiscal year?
So, your fiscal year is the period that you chose to report on for your organization. There are many that are on a calendar year, but there are many that end at different months. All of our clients are kind of all over the board in terms of fiscal year ending. I would say that for those organizations that might be working with like Chicago Public Schools, they go and align with their fiscal year end because they're getting funds or earned revenue from them. So it really is unique to the organization and the services you deliver when you want your fiscal year to end. So just think about maybe where your funds are coming from if you want to align that. But if you don't align it, that's okay because you're tracking everything properly for that period.
Great, thank you.
Mhm.
In our case, this is the next question. In our case, we are still building our financial structure. What would you recommend we prioritize first? Cash flow unrestricted, revenue, or reducing liabilities?
Okay. So you're building financial structure. That can mean so many things. I would say that could mean getting a system, the structure within the system to capture all of the financial transactions properly to create a report. So that would be like chart of accounts, maybe building in classes for statement of functional expense reporting that is required. Um, I would say cash is very important. If you don't have cash, you can't really function too much. So planning, development, fundraising, pipeline. And since it's mentioned as unrestricted revenue, I would say that's the best. You know, you want unrestricted funds all the time, but just remember when a funder gives you a promise to give it to you for 3 years, general operating, you are going to say yes, but that is time restricted as well. Um, Reducing liabilities, I would say you should always monitor that. Don't try to pay for everything on credit because eventually you're going to have to make payments towards that loan, towards that line, right? I've seen board members make loans to the organizations or like key related parties, but you want to just make sure that you're producing enough cash to function, right? That you have a long enough cash runway to be sustainable to deliver your programming and your mission.
Great, great, thank you. Someone asked, do you take any discovery calls?
Yes, I do. That's an easy one.
I thought that would be a simple answer. Yeah.
Yeah.
Uh, the next question, should the finance committee receive reports more frequently than just at quarterly board meetings? For example, monthly.
Yes, I've seen, I know of organizations that only meet quarterly who started out maybe monthly or every other month. And so when we're closing, we always provide financial statements monthly, whether or not there's a meeting. And I think it's great for the finance committee if they have time to vet it every single month, even though they're not meeting formally.
Great. And we'll do maybe we'll be able to fit this last two in here. Is it true that small nonprofits are better off not filing the postcard because it does not tell a story?
I mean, the postcard is for under 50,000. I would say you're probably a one-person team or being run by volunteers at that point with no payroll. So I'm just going to say file the postcard and grow and then go ahead and file like a 990 easy.
Great. Thank you, Yvonne. And this is more of a comment, but it may be helpful. This person said, "This is great. I got here late. That's okay. We don't mind." So I hope there is a recording. There is. Just a reminder, everyone, you'll be able to go to the Chicago Cultural Alliance website, and there'll be meeting the moment in the banner, and you can click on that and see the recordings for all of our sessions that we've had, and there'll be resources available as well through that. In the meantime, back to the statement. In the meantime, back to your point about fiscal years. I moved an organization's fiscal year to start on the IRS quarter system, which really helped to create clearer finances in our narrative we told to funders, members, and the board. And just wondering if you have any response to that comment.
Their finances. So the IRS quarter system, meaning the calendar quarters. Daniel, can you take yourself off mute and just clarify? I'm
Daniel,
not
if
sure.
you'll have
I'm
to,
not sure if Daniel's able to do that.
there
Oh,
he is.
thank
Yeah,
you.
there he is. Great.
Hi.
Sorry.
Yeah. So I inherited an organization that had their fiscal year start on May 1st, which was just like really hard to talk about because they'd always aligned it with their annual membership meeting, which was in May. But when we were trying to align with city funding, which starts in September, and then also a lot, the federal fiscal year, it just became really hard to like align all of those things, particularly as people go on vacation. Like I thought it was like a better ending point to begin the year in July, and then also, um, just be more in sync with. For instance, we were at the time we were going through a lot of federal tax credit programs that talked about quarters, right? And so it was really hard to sort of see what a quarter was when we started our fiscal year in May. So anyway, that was
Sure.
just a comment.
Yeah, absolutely, Daniel. And I think this is a great response to the earlier question about fiscal years and calendar years, you saw a need in terms of reporting and looking at your financial story in a way, and you adjusted your fiscal year to meet that need. So I think that's great.
Perfect. But that puts us right at time, but I ask for those that are still on the call and able to hang out just for a few minutes to please stay on and answer a few survey questions for us so we can help continue building and growing this series and reacting to the community's needs as we go through this. And I'm going to go ahead, Pooja, if you don't mind, start posting those, and that would be great. The first question, again, thank you for those that are hanging out. These hopefully we'll get through these very quickly. How relevant was this session to your role or work? Very relevant, somewhat neutral, slightly relevant, not relevant. And while we do that, I'd like to share some information on our next session here. Our next question overall, how would you rate this session? Excellent, very good, good, fair, or poor? So everyone knows, in 2 weeks, we'll be having our next Meeting the Moment session. It happens on average every 2 weeks. And our next one will be social media strategies, less content, more impact with Laura Herrera from the she is the Chief Marketing and Revenue Officer at the Griffin Museum of Science and Industry. So that'll be in 2 weeks. Our next question is a short answer, just a sentence or two. What is one idea, tool, or insight from the session that you plan to apply or explore further? Again, join us in 2 weeks for our next session on social media strategy. That'll be on April 9th. Same time, same day of the week. All right. Question. Thank you, Pooja. What would you like to learn more about related to this topic? A deeper dive into this topic, practical examples, tools, templates, or resources, opportunities for discussion or peer learning, a different but related topic. Just one more. We just have one more question. Thank you, everyone, for taking a moment to answer these. Final question. After this session, how confident do you feel about applying what you learned? Much more confident, somewhat more, no change. And I hope less confident is not a response in this case. Thank you, everyone, very much. Thank you, Yvonne. Thank you, Jill. Thank you for everyone's questions. Always a pleasure having you. And I know that you have another one coming up soon, and we'll be sending out information on that. But again, join us in 2 weeks, April 9th, for our next session. You can go to CCA's website, chicagoculturalalliance.org, and find Meeting the Moment and all the resources, all the recordings, and a lot more stuff about all the things that we do. Thank you, everyone. I hope that you have a wonderful rest of your week, and we'll see you soon. Thanks again. Bye-bye.
Thanks, everybody. Bye.